10 deep value stocks analysts are watching right now. Quick note before we continue. Ads may play during this video. Your support keeps this content free. Now let's jump in. The difference between recognizing a genuine value opportunity and walking straight into a value trap will determine whether you build wealth over the next decade or watch your capital slowly evaporate while you wait for a recovery that never comes. When a stock drops 40 or 50% and the price-to-earnings ratio falls into single digits, your brain starts whispering that you have found a bargain. The market overreacted, and you are the contrarian genius who sees what they don't. But here is what is actually happening in most cases. The market is not always wrong. Often, the business is fundamentally broken. For the business owner or retiree, the danger is not just a fluctuating stock price. It is the permanent loss of purchasing power and the silent erosion of your nest egg. Right now, we are in an unusual environment for value investing. Rising interest rates over the past few years have fundamentally repriced growth stocks, pushing institutional investors back toward companies with current earnings, tangible assets, and reliable dividend yields. At the same time, sector rotation and fear around a potential recession have created pockets of the market where quality businesses are trading at discounts that haven't been this steep in years. Professional analysts are compiling watch lists, and institutional money is quietly accumulating positions. But the retail investor is left asking the same critical question. How do I know if what I am looking at is actually undervalued or just cheap for a reason? That question matters more than most people realize, especially if you are in or approaching retirement. Value investing isn't just about finding stocks that went down. It is about understanding why they went down, whether the reasons are temporary or permanent, and whether the recovery timeline aligns with your actual financial needs. A 55-year-old with 15 years until full retirement has a very different risk budget than a 70-year-old managing required minimum distributions and trying to preserve liquidity for estate planning. The same deep value stock that might make sense in a speculative sleeve could be completely inappropriate in the core of a retirement portfolio. Analysts are watching these names because something changed, and your job is to determine if that change creates an opportunity or confirms deterioration. Let's walk through how professional value investors actually think about this. Deep value doesn't mean buying anything that is cheap. It means identifying businesses where the market has temporarily mispriced future cash flows, where there is a tangible catalyst that could unlock value, or where management is taking actions that will compound intrinsic worth even if the stock price stays flat. Without at least one of those three elements, you don't have a value investment. You have a speculation that sentiment will shift. Speculation is fine for a small tactical sleeve with money you can afford to lose, but it has no place in the bedrock of your capital allocation. So when analysts say they are watching a stock, they are monitoring for inflection points. Maybe it is a company that has been restructuring and is finally showing margin improvement. Maybe it is a cyclical business where inventories have normalized and pricing power is returning. Maybe it is a dividend payer that has been unfairly lumped in with weaker peers during a sector sell-off. These are the scenarios where deep value can work, but they require patience, conviction, and the discipline to sell when the facts change. Most retail investors fail at all three because they lack a consultative framework for risk management. Let's talk about what creates genuine value opportunities versus value traps, because this is where high net worth individuals get hurt. A value trap looks compelling on the surface. The price-to-book ratio is below 1, the dividend yield is above average, and the stock has dropped so much that it feels like it has to bounce. But when you look deeper, the book value includes assets that are worth far less than stated. This includes goodwill from acquisitions that destroyed value, inventory that is obsolete, or real estate that is encumbered. If the dividend is being paid out of borrowing rather than earnings, you are looking at a business in decline. This is the modern equivalent of the railroad company in 1955. The multiple looks cheap because the business model is dying. Contrast that with a genuine value opportunity. The business generates consistent free cash flow, management has a history of capital allocation discipline, and the balance sheet can withstand stress without forcing dilution or asset sales at bad prices. The reason for the discount is specific and addressable. Maybe there is regulatory uncertainty that will eventually resolve, or a product cycle trough that is temporary. These situations exist, but they are rare. Identifying them requires institutional-grade research that goes far beyond screening for low multiples on a public website. This is where the conversation gets critical for your portfolio construction. Even if you correctly identify a deep value opportunity, you still need to ask whether it belongs in your specific allocation. Suppose you are 62, recently retired, and managing a portfolio that needs to generate income while preserving capital for the next 30 years. The question isn't whether a particular deep value stock might double over 5 years. The question is whether tying up capital in a turnaround story makes sense when you need liquidity, income, and a hedge against inflation. This is the part most people skip. They hear about a stock analysts are watching and assume it is a buy signal, but professionals distinguish between a watch list and a buy list. Let's work through a realistic example. Suppose there is an energy company beaten down because commodity prices dropped. The stock is at 6 times earnings with a 7% dividend. On the surface, it is attractive, but you must ask the harder questions. Is the dividend sustainable if prices stay low for 2 more years? Does the company have hedges in place? Most importantly, how would this interact with your other holdings? If you already own energy exposure through broad index funds, adding a concentrated position in a single energy stock isn't diversification. It is amplification of sector risk. In retirement, that clustering can be devastating because you don't have the earning power to recover from a correlated drawdown. Now let's talk about the tax implications, which is a layer most people ignore. Deep value stocks often have tax complexity that changes the real return profile. If you buy at a low basis and the stock recovers quickly, you are generating short-term capital gains taxed at ordinary income rates. If you are also taking required minimum distributions from traditional IRAs, those distributions are ordinary income too. Stack them together, and you could push yourself into a higher tax bracket, trigger Medicare surcharges, or increase the taxation of your Social Security benefits. The headline return on the stock might be 20%, but your after-tax return might be much lower once you account for the tax friction. Conversely, if the stock doesn't recover and you sell at a loss, you can harvest that loss to offset other gains. But you must be strategic. You can only offset up to $3,000 of ordinary income per year with capital losses. If you take a $15,000 loss on a value stock, you are looking at 5 years to fully utilize that loss unless you have other gains. Meanwhile, that capital was tied up in a position that went nowhere. This is the opportunity cost that many retirees fail to calculate. The money you lost wasn't just the decline in the stock. It was the compounding you missed by not having it in a more productive asset. Furthermore, deep value stocks are often smaller, less liquid names. They might trade on lower volume with wider bid-ask spreads. If you need to exit quickly for an emergency or a major business expense, you might not be able to do so at a favorable price. During a broader market sell-off, institutional investors often dump their least liquid positions first to raise cash, meaning these deep value names can get hit the hardest. This illiquidity risk is a serious problem if you have allocated a meaningful percentage of your retirement assets to positions you cannot easily exit. The psychological piece of this is perhaps the hardest to manage. When you buy deep value, you are taking a contrarian position. It feels intellectually satisfying to be smarter than the crowd, but it also means you are going to be wrong sometimes. When you are wrong with value stocks, the losses can persist for years. The stock doesn't just bounce back, it stays down while you second-guess your thesis. This is why discipline matters more than intelligence in value investing. You need to define your thesis up front and have the emotional fortitude to sell when it breaks, even if it means realizing a loss. If you're going to consider deep value at all, start with 4 specific criteria. First, free cash flow generation. Does the business produce cash after capital expenditures? Second, capital allocation track record. Has management returned cash to shareholders or destroyed value through empire building? Third, balance sheet strength. Can the company survive a recession without raising equity? Fourth, catalyst visibility. Is there a specific event that could unlock value in a reasonable time frame? Without these, you are just waiting for a multiple expansion that may never come. Practically, deep value should represent a small, defined portion of your portfolio, perhaps 5 to 10% at most for most retirees. The core of your allocation should remain in diversified funds that provide broad market exposure and liquidity. Your deep value sleeve is tactical. It is money you can afford to be patient with and money you are willing to lose if the thesis is wrong. You must also think about which accounts hold these positions. A dividend-paying value stock might be better in a taxable account for preferential rates, while a high-growth turnaround might belong in a Roth IRA where the gains compound tax-free. Investing is not about finding the next big winner. It is about building a portfolio that aligns with your goals, your timeline, and your risk tolerance. Deep value stocks can be part of that portfolio, but only if they serve a specific purpose and if you understand the risks. The analysts watching these names are doing so because something has changed that might create opportunity. Your job is to determine whether that opportunity is relevant to you and whether the potential reward justifies the complexity and the risk. To recap, deep value investing is about identifying businesses where the market has temporarily mispriced future cash flows. It is not about buying cheap stocks. It is about identifying quality, liquidity, and catalysts. For retirees, this should be a satellite position, not a core holding. Focus on free cash flow, balance sheet strength, and management quality. Every position must be evaluated in the context of your entire financial picture, including tax implications and correlation with your other holdings. If you found this analysis valuable, subscribe to the channel so as not to miss our regular updates on retirement planning and institutional wealth strategies. Share your thoughts in the comments on which sectors you think represent the best value right now, or ask a question about how this fits into your own estate plan. Click the thumbs up button to give us a like as a thank you for this valuable content. I am not your financial advisor, and this content is for educational purposes only. Seek professional advice from a qualified fiduciary or tax professional before making any significant changes to your portfolio. Your wealth is too important to leave to chance. Take the time to build a plan that works for you.